Hi, it's Troy Griggs with Obsidian Wisdom. Welcome to another Retirement Readiness Thursday. So, today we're going to do something a little bit different. We're going to take a look at the market. I've been getting a lot of questions about market analysis, the things that I look at, and I put together some information. I don't want to overwhelm you. I can literally put together like hundreds of slides and graphs and a whole bunch of information. But do you really need to know all that for retirement, right? Like, do you really need to know all that information? And I would say no. So the plan for us today is to go through some the market as a whole, go through some market indicators, see what we can take from this information and how we can adjust and prepare accordingly for our overall retirement plan. And so, what's going to basically lead us is let's first start just by talking about how the market as a whole is doing. And for those that don't know, I am live. It is April 17th. I feel like I'm supposed to say that so you know that I'm live. And basically, the Fed met this week, and the Fed just was like, "Hey, look, we have a dual mandate. And if you've seen any of my videos where we talk about the Fed, their mandate is the same: keep unemployment low, keep inflation low. That is the goal of the Fed. That's what all of their decisions stem from. So they increase, decrease interest rates, they impact the money supply where they tighten it or they loosen it based on their goal of creating low unemployment and where they're able to create low inflation. And so currently they're looking at the information, the tariffs, the market, and all that. And they said, we are slightly concerned about our dual mandate. So they said, we don't know what's ultimately going to happen. And that is something that I think when you're like, all right, well, what does that mean? And what they would say is they're worried about stagflation. And if you haven't heard stagflation, it's no problem. It's like a made up word if we really think about it. We take the word stagnant, which is right non-growth, a market that's not moving, and inflation, which is right inflation. So we're talking about a stagnant market with high inflation. And then that is what their current concern is from the Fed. And so they're worried about the stagnant market because if you think about it, there is a new policy kind of every so often, multiple times a month, where if you're a business, you're not 100% sure what you should do. You're trying to wait just to make sure because there's a tariff and then there's a pause, and then there's a tariff and there's a pause. And because of that, companies are not hiring. They're not 100% sure whether they should grow or hire, whether they should move different industries. I remember reading this one woman, she was talking about her business. She said she had a small business. She has about 2 months supply of her inventory left. It was something in the baby industry. And she said that the rest of her product was in China and that it normally costs her $30,000 to bring her product over. And she said that currently with the tariffs, it would cost her like $300,000. So she was sitting there and she was thinking maybe what I should do is I should move my product to Australia because they don't have tariffs, right? So China to Australia, I'll repackage it in Australia and then I'll bring it to the United States and I'll have my inventory. She said, I don't know if I'm going to do that because I don't know what might happen. Like, I don't know if they'll change something with our relationship with Australia and the product and different things. So she's like, I'm just basically kind of waiting and seeing, but I only have a couple months to figure this out. So that's what she basically said. And then we have other instances where people are excited. They're like, this is going to give us a competitive advantage. We feel very good about this. And so, where does that put you when it comes to your market and the overall investments? But what we do know is the Fed is saying that more people are cautious waiting, stagnant, and that there are the risk of having higher costs, which would be the idea of inflation. And while I think we generally accept that there are going to be higher costs because that's the idea, I want to make American industries more competitive. Well, more competitive in what way, right? More competitive in the way that we have prices that work for them, right? So that's what the Fed said. So the Fed said the economy is kind of stagnant. You look at earnings are kind of soft as far as wages going up and things like that. Right now, inflation is still softening, so we're still okay, right? So that is the overall market, how the market is looking. And then what we would then move into next is where we start talking about, all right, if all of that is true, then ultimately, what should I be doing with my money? And so the way that I try to put it together for you is I really wanted to be able to say, let's have some green like go, yellow like caution, red like stop. and we went through a handful of industries, and I went through a bunch of charts and a bunch of information. And my goal is to just give you the highlights where you're able to say, okay, I understand what Dre's overall thoughts were. It's not that you have to go by it. Obviously, I'm not with you right now, so I don't know your personal situation. But if you're someone that's 5 to 10 years out from retirement, that was kind of the prism that I went through. All right, so let's go through and let's just see how it's looking. So, of course, the idea is that the markets are mixed. We have some industries and sectors that are rising, some that are shaky, and that, right, it's normal. That's what happens. I tell you all the time, in economics, there are winners and losers, but there's never all winners. There's never all losers. You can be in a recessionary environment, and it could be literally the best year your company has ever had. You can be in a time of economic boom, and it could be the worst year your company has ever had. And sometimes what I do want to go through is this idea of there are sectors there that perform better depending on what the issue that we're dealing with is. And so I'm going to go through a handful of these for you. But if you really think about it, it's kind of like the idea of COVID. When you look back at COVID, what sectors perform really well? And we know media perform really well. Well, why was that? Because people were stuck in their house. They couldn't go anywhere. So if you're stuck in your house, we know that Zoom did really well because they were a video media company. So everybody was using Zoom. We know that Roblox was gangbusters because all the kids kind of go outside and play. And we know healthcare because they're making the vaccines that they perform really well as well. That the economic environment does give us an idea of what sectors should perform very well. And then which ones didn't perform well? Well, naturally the cruise lines didn't perform well. They weren't able to have cruises. We know the other, like movie theaters, didn't perform well because they were closed. Gyms, same idea, they were closed. So you have to ultimately, you look and you're like, who benefits from each of these economic environments? And so that's what we're going to kind of go through today when we're talking about the current environment that we have. All right, and so what I'll do is, and I may need to zoom it in just a little bit for you. So what I did is I just took a very high level screenshot. I didn't want to go through a lot of the information to have you feeling slightly overwhelmed. But what I can do is I will share just really anything that you have in the questions. I can go through in more detail, and you don't have to worry about it right at all. Just any additional information that you have. But let's start with our green sectors. So technology is still green, and the reason technology is green, and as far as the bullets that I gave you, I said, right, the AI industry is still opening, it's still growing, it's becoming more accessible to more and more people. We're in the very early goings of it, but the signs is it's not letting up. And so we know that we had our magnificent seven, the seven largest American companies that were positioned best for AI. And that was like our Apple, our Microsoft, our Meta, our NVIDIA. We had a handful of companies where like, this is going to be a great industry. And so they're still ultimately leading the market. So that's still very beneficial, really, when we're talking about any and everybody as far as what we're trying to get done. So when I'm looking at the tech industry, what you'll notice is, and the way you would look at that chart, you don't really have to go into a lot of details. Basically, what we're saying is the dark blue is the 5 stars. So this is a report that I'm given a lot of information. All of us that do trading for a living for people, we have to have the information to make an intelligent decision. The more information you have, the better off you're doing. I've seen it done in a variety of ways. You can have your own team where the analysts work inside of your firm. You can have other people and use their analysts. I've seen some that have, where you can kind of have like a virtual assistant somewhere. I've seen some where they have an entire virtual office in the Philippines where they can pay literally hundreds of people to reach out and get the information. But we make investment decisions based off the information that we get. And so I get mine from Morningstar. This is a particular report that I took a snip from, and this is for financial advisors, right? So this isn't the one that they give just right to everybody. But what you'll see is the very dark blue at the bottom is their 5-star rated companies. And then the light blue is their 4-star rated companies. That gray is their 3-star. Then like the light orange is their 2 stars. And then that reddish color is their 1-star. And so they will go through and they'll say, hey, this is how the market is doing. The little number on the top, or the little lines on the top, where there's a little bit of a gray and then there's a little bit of a blue. What that is basically the gray is the market as a whole. So that's how the S&P 500 has performed. And then the blue tells you how this particular sector has performed in relation to the market. And so you can see that it has outperformed the market as a whole. And that what we're basically looking at is the performance of the tech industry has continued to do well. and that the index is up. It's like up 11% on the trailing 12 months compared to the 11.5% of the market. So they're basically right one on one with each other. And so another green we have is healthcare. Healthcare, as you know, anytime we're dealing with a recession or anything of that nature, healthcare, generally the demand stays there. If I have to spend any money, I'm going to spend it going to my doctor, going to see it. We also have naturally in the United States, we have a much larger aging population. I believe that what I read is we have what is I think it's like 15,000 people retiring every single day. As far as the baby boomers that hit 65 and are retiring, it's like 15,000 every single day, which is like a crazy number when you really think about it. So of course, if you have 15,000 of your population that's retiring every day, and that healthcare becomes something that's very important and it stays important, and it's even more important as we age. And so what you'll see is it breaks the sector of healthcare when you're looking at it. And so it ends up breaking it into different sectors. So we have the healthcare, you have the devices, the drug manufacturers, diagnostic and research, biotech, providers and services, healthcare plans, and medical distribution. So these are all different parts of the sector that makes up healthcare. You can see that it's actually been underperforming the market, but the reason that you normally will say, all right, even though that's true, while we would still feel generally good about healthcare, is basically it's a ratio, right? So the idea is if a certain sector averages, let's say, a 10% return, and last year you had a minus 10% return, that means it's more likely that you'll have a 20% return next year because you average that 10%, right? Averaging 10% doesn't mean I get 10 every year. It means that that's my average. Just like if last year you had a 20% return, it's more likely that that sector will lose and underperform the next year because, again, we're averaging the return. And so even though the healthcare looks like it's softening, when you take away the emotion, which is if it's going down, I'm selling. Right. If it's going up, I'm buying because right, that's the opposite of what you actually want to do. If you buy it when it's going up, what are you doing? You're buying high. And if you're selling it when it's going down, what are you doing? You're selling low. And I think we can both agree that that would be a very tough long-term strategy. So when you're looking at the healthcare sector as a whole, the demand is steady. You can see that there is a reasonable amount of the blue, which is basically 4 and 5 star stocks inside of those particular portfolios, that there is a very large amount of them. The only sector, and I am sorry that it's so small, I know you can't really see it, but what I will do is I will, if you just like send me a message or comment or something like that, I will send you this PDF. I'll send it for free. You don't have to like sign up for anything or anything because I know you can't quite see the little tiny bumps on it. So I do want you to be able to see it, but that is medical distribution. That's the only one that is actually looking kind of soft, where you wouldn't want to choose if you were choosing inside of the healthcare sector. That would be one that you'd be a little cautious of. But overall, as far as the devices and just healthcare in general, it's doing very well, and so you feel pretty good about that. All right, and then so I think I have one more. I have one more green. I think it was three green sectors that I saw, and consumer defensive. See, I knew it was three of them. And so this is essentials like food and hygiene. Again, uh, these are things that we're going to spend. If I'm cutting back on certain expenses, these are not the expenses I'm cutting back on. So if you're talking about conglomerates like Procter and Gamble with toothpaste and things like that, you're going to wear toothpaste. You're going to wear deodorant. You're going to use lotion, right? You're gonna have soap. There's certain things that you're going to keep buying, and so no matter what's going on, as far as my concern and how I feel, those would be sectors that I'm comfortable saying they're going to do okay. That if I was cutting back anywhere, it would be cutting back to spend money in this sector. And right, and that's the idea. But it's not that the entire market, even though the market has had a really rough first quarter, it's not that the entire market is going down. It's that certain sectors are underperforming or they're going down. And so if you're someone that's planning on retiring somewhere in that next 5 to 10 years, then these would be the sectors that we would consider green for like the next 5 years. Not saying that if your timeline was a little bit larger, that will work for you, because it wouldn't. It changes based off of that. But all we're basically saying, and you can sort of see it as, so consumer defensives, and then retail defensive, and then non-beverage alcohol. And then of course, beverage alcohol is the one that does the best, because when times are rough, people drink more, right? People are stressed out, they drink more. And that's basically what that's saying, that the trend is the same, that if you're moving into a recessionary environment, people do spend a little bit more money on beverages and different foods like that. And that even though personal savings as a whole has declined, That is the sort of the small concern that you have. And then obviously when people are spending money on education, these are things that if I'm going into a recession, I don't even know if I'm going to have that job opportunity that I was trying to prepare myself for. So maybe it makes sense for me to push back on that. Now, sometimes the opposite happens where I was going to leave my job, but I'm going to stay because I don't want to get fired in the new job because it's going to be a recession and like last in, first out. So what I sometimes will see people do and what we've seen people do historically is like, well, if I'm going to stay in my job, I'm going to try to level up. So maybe my company will pay me a tuition reimbursement or something like that. But that's basically what we're saying. So that's why tobacco at the end, education at the end, why they're green. It just means that they're fairly valued, and that's really the big takeaway when you're talking about evaluating a company. It's not always that it's a good buy or a bad buy. It's more like Shark Tank. What is the price I'm paying when I buy? Because based on the price that you're getting, you can determine if it's a good idea. That if I'm buying something that's overvalued, well, then that is something that I will be concerned about. And so, but if you're buying something that's undervalued, which is what we're kind of saying when you're moving into recession, that these are going to be an industry that performs much better. That people are going to go back to their consumer staples, are going to go back to the normal tried and true things that they spend money on. And so, of course, things like alcoholic beverages, as people get stressed out, those type of companies and stocks, those would be good investments. And that tends to be how people feel. So those are our greens. Now we want to move into our yellow. Our yellow is our caution. Our caution is more or less saying the way it's looking, there's value to be had, but there's risk with the value. And because we're talking about trying to be within 5 years of retirement, 5 to 10 years, there is a level of risk that we're supposed to avoid as we get closer to retirement. And oftentimes what happens is the thought is, well, I need to make up for lost time. But that's not actually how you do it. You don't make up for lost time. You have a plan that's set in place and you follow the plan. And most plans, as you get closer to retirement, you take your foot off the gas. And the way I would describe it is, when I'm driving, and I don't really speed as much anymore, but when I used to speed, I would never speed as I got close to my exit. Because in my mind, if I've driven, like 4 hours to visit my parents, and I've driven for 3.5 hours, I haven't gotten a ticket yet. That last 30 minutes, how much time am I going to save speeding that last 30 minutes? And it would be less than 5 minutes, right? Like it would literally be less than 5 minutes. But if I got the ticket in the last 30 minutes, how would I feel? I feel miserable. Like I wasted the trip more or less. And obviously that's hyperbolic. But you get the idea is that if I'm going to speed, I want it to at least be over a longer period of time where the ability for me to benefit from it exists. But if I'm speeding at the very end where I'm not really saving much, I'm taking all the risk of getting a super expensive ticket. Florida has very high priced tickets, dude. I mean, I'm saying. And so Florida has a high price ticket. So I'm going to get this ticket in the last like 20 minutes of my drive. And I was going to save maybe 5 minutes. So for me, if you get closer to the exit, then you need to slow down a little bit. There is no benefit in you risking getting a ticket by you like driving as fast as you can, because you don't have the wiggle room to even make up for that loss. And that's why we normally will take our foot off the gas as you get a little bit closer. So when you first start looking, we're going to say our caution in our yellow is the financials. Right? So bank stabilizing, not booming, they're watching interest rates. We know that banks do relatively well when the interest rates are high because they're the ones giving out the loans at the higher interest rates. So they make more money. They make more money on the loans on the houses. They make more money on the business loans. But at the same time, if you're going into recession, the risk on their books is the people's credit cards, right? Like the people's credit card debt. And so you have these people, I think it's over $1 trillion last time I looked at it. You have over $1 trillion in credit card debt. The middle class is well documented that they are living off of credit cards to sustain the middle class lifestyle. So as you go into recession, as you move into times of uncertainty, that's basically the exposure that these banks have. These banks have $1 trillion out of debt, and it's possible that these people are going to start defaulting on these loans and the interest rates and things like that. And so that's why you often have to be very cautious when you go into recession, when you're dealing with the financial industry as a whole. It's not that all of their loans are bad, and because it's not. It's not even that all of them aren't going to win, because some will. But it's to recognize that they may be overexposed. And so that's what you're seeing here. And so you see the credit services is all the way on the right. Capital markets is the investments they give out. And then insurance is the highest risk one that they have. And so insurance looks relatively expensive. But most of the financial sectors, it's fairly priced. If something is fairly priced, it means that we don't have it fairly priced and we're maybe 5 to 10 years out from retirement. It's not always the best sector for us to go into because we're looking for stability and we're not 100% sure, and there's not as much of an upside as far as the risk that we're taking. And so that's why we would be looking at that. And so you can see that the banks are kind of high on leverage. And so that's why the financial sector ends up being a yellow. There's some good, there's some not so good, but based on the timeline, it's something that we probably want to be very cautious about. So we move into industrials. Industrials is going to be one of the yellows because we just really don't know. But it is a global economy in the industrials, and that we're still trying to get everything figured out for inflation. We know that when they're building houses, that things like lumber and steel and price were going up, whether it was the supply chain issues from COVID, whether it was just the overall logistics and the issues, and now with the tariffs, it's just very hard to know what is going to be the price that people pay. There was a little bit of time where everybody was paying no matter what the house. Remember that when no matter what the house was, people were like, "Oh, I'll buy that. Like that's no problem for me. Yeah, I'll do that. That's still good." And so in this particular one, when you take a look at it, you see waste management is all red, right? So we would avoid that portion of the sector. But there are undervalued industrial stocks. So conglomerates, again, that one is also a little bit slightly higher price. But you see aerospace and defense is seen as a very good sector in industrials. You can see business services is doing okay. Industrials as a whole is doing okay. Their products and transportation. So you can see they're doing okay, but it's like a 50-50. And then farm and machinery, surprisingly, is actually still doing pretty well. So when we're looking at industrials and we're just trying to figure things out, we have defense contracts that we look at. We have stable, like how many orders are in the books. All of this stuff is things that we will look at when you're trying to put this information together and figuring out what you would want to do. But the risk, what does they say? The juice and the squeeze. I think that's what they say. Like the juice isn't always worth the squeeze, is what I think they end up saying. And then I believe our last yellow, our last caution is the energy. I long term, I love energy. It's so hard to argue against energy because people have to use energy, and as more and more developing countries try to become industrialized countries, more and more oil and resources are needed. Right? That's just an economic fact. And right now, China trying to become industrialized, where they're still considered developing, and so as a result, they're consuming tons of oil, and they're trying to get more and more of it. And even the United States, we consume a ton of oil, and we're talking about clean energy and fracking and different things. We consume a ton as well. Now, it goes without, it's probably worth mentioning that China also is the number one clean energy producer in the world. They have the most wind turbines of anyone. We have wind turbines, but they have the most wind turbines. So when you're looking at these resources, you're looking at when you're looking at energy, everybody needs it. It's even you and me. If we were trying to pay our bills, on the list of bills, what's going to be kind of at the high? What bill would you be like? Yeah, I don't want to miss that payment. It's probably going to be your energy because I can't charge my phone. I can't really take a shower. I can't do so many things. It ends up being very important that we keep an eye on these things. So oil prices, of course, the global news has impacted them, but I do like energy as well because energy normally pays dividends, and a lot of people enjoy having dividends in retirement. That's why people like energy, and we will talk about utilities a little bit later as well. But that is one of the things that you get as a benefit of being in the energy sector. So we find that ends up being something that people enjoy. In this particular one, we know that the integrated energy, that one's actually an undertapped resource, and so that one has the best star rating as far as options available for you. See, service and refining, those are both doing pretty well as well. And then just overall energy and exploration, again, those are doing well. But naturally have more risk when you're doing exploration because they could spend millions, if not billions of dollars trying to find oil and different things, and it just doesn't happen. There's just nothing there. And so when you look at the different energy companies, you would then decide, all right, based on your projections, what would I do? For me, it's very simple. If I was you, I would probably just focus on sectors. We don't really have to go into detail about the individual companies. You look at it normally from the overall economics, then you look at the sectors, and then you could stop there. You could just choose the sectors that you want and then build your portfolio allocation from there. And then, or you could go another level further and then you pick stocks. But normally when someone's picking stocks, you normally stay around you probably like 20 to 30. That's normally going to be a good asset allocation for you. All right, so then that's it. Hopefully, this is making sense for the market outlook. If it is, let me know in the comments or ask me a question or a thumbs up or something. All right, so let's talk about our struggling sectors, the ones that if you were 5 to 10 years out from retirement, that you would probably be the least comfortable based on that timeline. You can't argue with real estate long term, but we're talking about if you're within like a 5 year timeline. And so there is the rising rates have slowed demand. We've seen that. Right? We've seen that interest rates were very low. Even when you just think about it from just a human psychology perspective, you were able to refinance at historically low interest rates, right? That's all they kept saying, historically low, historically low. Never been like this before. And so you have a 3% interest rate. And then it went up and it went up to maybe 7, 8%. And I believe right now it's kind of closer to like 4 to 6%. And you're sitting there and you're like, do I want to refinance? Like, if I sell my house and I have to move, do I want to refinance from my 3 to a 5? And most people would say no, because what you're basically going to do is you're going to go out in the market, and with the higher interest rate, you're going to have the same mortgage payment and have less house. And for most people, that math isn't mathing. And that's why the real estate market slows when interest rates are a little bit higher. And right now, the Trump administration, they're like, hey, Fed, lower the rates. And the Fed right now has been pausing the rates. Like, we're not really sure what to do. Everything's kind of volatile. We're just not really sure what makes the most sense, because the Fed's trying to make the long-term decisions. So if real estate is going to have higher rates, which keeps people from selling their home, unless you absolutely have to, maybe you're in the military, maybe you had to move, unless you absolutely have to, then that lowers the inventory in the market, and now we're bidding. So there's a handful of houses out there, but the rates higher makes it a little bit tougher. And so for most of the time, you often want to be careful when we're just talking about your overall exposure and the risk that you have when it comes to that. And so when we're normally looking at real estate, for me, I really do enjoy REITs in the stock market. All you have to do is find a really good company, and they have to pass off about 80% of the income that they receive. So it's normally a really good investment. You can see, as far as the market as a whole, that over the last 12 months, that real estate has gained 12.4%, versus it's slightly better than the market. The S&P 500 U.S. equity market has been 11.5% over the last 12 months, trailing 12 months. So we're slightly above the market, so we're still performing pretty well. You see that we have a lot of 5 stars and 4 stars, so we're still liking the way real estate is performing. But it is something that, as far as going forward and retiring and the volatility and dealing with that in the next 5 years of retiring, that it would be a tougher decision. Now, if you're someone that's on the upper end, where it's like 5 to 10 and higher, real estate would probably be a really good spot for you to be able to invest in. There's still obviously discounts, and at some point, the interest rates will go down, and then people will be selling, because that's what people do. If you're going to start selling, then I'm going to start buying. And then we have seen, and I remember reading it, that new start construction is at like an all-time high. And some people are concerned about that, because they said that's what happened in 2008, and where we're overextending ourselves, it's going to be a whole bunch of empty houses half built. Other people say that that's it shows signs of a strong economy. And if you ask me, the truth is, I don't know, right? I'm just like, as far as the data, I would lean towards it being a sign of a strong economy. And we're just like, they're still building. People still need homes, even though the interest rates are a little bit higher. So people don't want to sell their home, but people do need homes. So I would probably lean towards it being a good thing. But it's just worth mentioning that if you're within that 5 year range, then it's probably a little bit too much of an overexposure, just from a risk perspective, not from the upside, but from the possible downside, because we don't know. The next one is going to be utility. So we started talking about that. Now, of course, right, we talk about utilities all the time. That is a very defensive. People have to pay their utility bill. But the profits, right? You're investing from a Shark Tank perspective, right? So if you're investing from the Shark Tank perspective, you are investing with the idea of, I'm going to give you money, and you have to make a return on my money, and then you pay me back that return. So are people paying their utility bills? Yes, they are. Will people prioritize their utility bill? Yes, they will. But are the profits in utilities the same? And that is where we say, no, they're not. That the profits are actually starting to be squeezed a little bit. And so when your profits are down, what does that ultimately mean? It means that you're overpriced. And so utility stocks right now are slightly overpriced. And if there is a correction, which we've been seeing the first quarter, that would normally, overpriced stocks is what gets corrected, because that's what's been constantly happening. It's not that, like, basically the market lost, I think it lost like 6 trillion or something. I think it lost 6 trillion is what I read. Why did it lose $6 trillion? It lost $6 trillion because when you add tariffs, it increased the price of the product. And if you're not 100% sure that that company has the brand to be able to raise their prices to offset it, that means that you've shrunk their margin, right? Like that's ultimately what that means. So if you shrunk my margin, you shrunk my profits, I bought that stock with a certain profit in mind as an investor, and you're telling me my profit is half of what it's supposed to be, that means I overpaid. Right? That means I spent too much on it. And if you spend too much, what do you basically cut your losses. Now, that's what the professionals would naturally do. Hey, look, it is what it is. You win some, you lose some, cut your losses, find a new position. Obviously, other people will say, no, I'm going to hold on to it. I believe in it. It's going to come back. I don't know. Most of the time, you cut your losses. Now, with that said, it's always fair to say that we're not in the game of the day traders, right? Because their position, their value add is to be able to generate a return every single year that offsets the cost that they're giving you. If you're longer term investing, you can maintain very good companies that you believe are great companies, and they're just having a down year. But if you're like a hedge fund, you don't get that. That's why there are stocks on sale right now, because they're selling really good companies, not because they think they're a bad company, but because they're a hedge fund and they're charging like 20%. And because you're charging that, you have to generate a high return every year. So they will move off positions of really good companies. And then half the time they buy them back. That's why when you see the stock market, it goes down like yesterday, and then it goes up like today. It's technically them trying to make money on that spread, where I sold it high, and then it went down, and then I bought it back low because that was a great company. And so, if you're someone that's day trading, then you would obviously do that. I'm not day trading for you for your positions, and so I wouldn't be doing that. We just wouldn't move the position, and so it would go down yesterday, it would come back up, and we'd be flat, and we'd be fine for it, and so we'd have a longer term position. But so keep in mind, yes, utilities, of course, they are very defensive positions, but they're under pressure from a pricing perspective, especially if you're talking about, and that's the part that we don't know about. Right, you've been reading with the retaliatory stuff with tariffs, where I think Canada's like, hey, look, we give you a lot of oil, and they see other countries that are, hey, look, we give you a lot of energy, chips, and different things like that, like minerals and resources for your chips, and we may slow that inventory, which would obviously skyrocket prices. Good old fashioned supply and demand. If the supply goes down, demand goes up, or demand stays the same, that means we have to bid more, right? That's why Cuban cigars were super expensive. Not because Cubans, I don't know, I don't smoke. It's not that Cuban cigars were necessarily worth that price. It was because the US did not allow you to buy them. So the only way you got a Cuban cigar was if someone smuggled it in. And so people paid a lot of money for them because you just couldn't get them. It wasn't, once you have trade relations, you have trade relations, which always leads to the question people have asked me all the time. And I was like, the truth is, because we want our cake and eat it too. But it's like, well, if China is as bad as they say, then why don't we just not trade with them like we do with Cuba, right? Just like, hey, look, you're not allowed to trade with China. The US, you can no longer buy Chinese products. And the reason is because we want our cake and eat it too. We would like to be able to have our US businesses making money and generating the revenue inside of China. And then at the same time, we want to be able to control the inventory, which is fine. That's right. That is neither up nor down, left nor right. It's just simply saying that it would actually be devastating. And that's why tariffs are generally seen as a negative. And we're not talking about whether it can or can't do something. It's like a nuclear option, right? Of economics that we both lose. Tariffs, we both lose. There is not a position where a tariff helps you, right? So when someone's like, Dre, who's winning the trade war? Is it China or the US? It'll be like me saying, hey, Dre, who's going to win if the US shoots a nuke at Russia and Russia shoots a nuke at us? Who wins? I would say we both lose, right? Like that is right. Nobody wins when you shoot nukes. And tariffs at 150%, like nobody wins in that, right? Like that's the reality of it. And so I know that you want me to pick a side, but I'm just not like that, because I get paid off of making you money, and the opinionated people get paid off of saying what what we want to hear. And so they can say what we want to hear, and I have to say what I believe is the best fiduciary financial advice I can give you. All right, so then consumer cyclical, a very fancy way of saying that there are certain things that we go in cycles. Now, if I'm able to, I will, and if I can't, I can't. So in the summer, what was very likely to happen, a cycle in the summer? Vacation. So I would say normally in the summer, you'd expect energy prices to go up because people are traveling more. You would normally expect cruises and even movies because they put a lot of summer blockbusters out. These are normally sectors that we would say, oh, they're going to perform very well in the summer because that's just what people are doing. So we're going to go on cruises and these different trips. But the reality is we have to kind of pull back on that a little bit. So we're talking about luxury and retail spending being down, inflation, and the idea of it hitting the wallets. That is something that we would be very mindful of. And so when we're looking at the red, if you're going into a recession, then people aren't going to be spending on luxury. They're not going to be buying the jewelry, taking the trips, and things like that. That is your normal position. That if you feel like you're going into a recession, you're 5 years for retirement, your normal position is going to be like, yeah, I don't think we can do that. And so that is basically what we're saying. We're saying that these are relatively going to be high and slightly overpriced because of the market that we're going into and because of the timeline that you have. And so when you look at like personal services, that one's all red as far as that sector, red, that's out. We did talk about home builds. Home builds are doing well. And so those are still a good industry. Apparel for clothing is fine. Restaurants are a little bit down. And then you can see that there is value in travel. People are still planning on traveling some. And so that's what we're looking at. Automobiles, whether it's used or new, we'll see. In the automobile industry, we're trying to figure it out. Right now, I know the president had said that he didn't want them to raise their prices, and he was also exploring whether to give some carve-outs on the tariffs, because right now the automobile has an automobile tariff, and then they have like a steel tariff, and then I think they have like the tariff from the company that they get certain parts from. So the tariff ends up hitting the automobile multiple times. And so I know that they were researching whether they should have some carve-outs. But because of that, it then creates opportunity. If everybody is like, well, autos are down, the way, right, Warren Buffett, he's famous for saying it, he's cautious when people are greedy, he's greedy when people are cautious. The automobile industry is going to get through this. And so it's just really a question of when. If you're someone that's retiring in 5 years, you probably don't have the time to wait them out. But it doesn't change the fact that long-term automobiles is probably still good. But if you're within 5 years, it's probably going to be a red. And that's the position we're going from. So your basic materials, they're super very volatile. And as a result, it's not something that you would normally be in a position of when you're about 5 years from retirement. And the reason is a lot of it has to do because of our trading partners, and we're just not 100% sure what that's ultimately going to look like. And so when you're dealing with a very volatile market, if you're not someone that enjoys looking at this stuff on a regular basis and staying in the market and doing your thing, then it would make sense for you to avoid it, because the worst thing that can happen is you end up having to sell low because emotionally it was very difficult, and you obviously got to be asleep at night. And so you just have to think about that. And so when you're looking at the basic materials, a lot of the concern that we're dealing with is these are great companies. We're just not 100% sure how the tariffs are going to impact them, because there are a lot of tariffs on some of these things. So because we're not really sure, we don't know. So building materials is kind of one of those. But you did see forest products, right? Still great companies. Building materials, they sort of just hang up on that. And then the metals and mining, there's going to be a handful of good companies in there. Agriculture is always not always, ends up a lot of time being a good one. Again, it's just a stable industry. People have to eat their food. But what you can see is that it's positioning. So you can see the little gray line on the top. That's the regular equity market. So that's at about 11.5%. And you can see that it's only been about 4% for basic materials. And that ends up being a little bit of the decline, right? When it started in March, they were basically the same. And then you see that they were back together around July of 2024. And then since this year, the gap has been getting larger and larger and larger. And so as a result, it ends up being an opportunity for those with a longer time horizon. But for someone that's within a 5-year time horizon, it probably wouldn't be. And so some of the things that when I was looking at it, they said the price of like lithium, that was rising. And talk about the price of potash, which I don't remember what that was. But it was lithium, and it was the prices of lithium potash were higher. And whether that is from the AI, where I need these minerals and these resources, or whatever that looked like, we were just saying, hey, this is probably gonna be a rough industry for someone to be in that's looking to retire in 5 years. Right. And so we're almost done. I think it was just, yeah. So then communications is the very last one. And so there's not as many communication sectors. And of course, it's very volatile because there are so many companies that are opening streaming that are kind of eating each other, and the people aren't really watching TV the same way they used to. So they were talking about advertising dollars. And then you have Google, which is now being sued by the United States as a monopoly on advertising. So there's just a lot going on in media as well. And then the overall consumers with the movies and different things where it's just a lot going on. We don't know how well these communication services, the media companies are doing. But and then when we talk about the metaverse for interactive media and stuff like that, there are great companies inside of the industry as a whole. And as a result, that means that there is great opportunities that are available. It has been outperforming the stock market over the last 12 months, where the return inside of it has been, what is that? I'm looking at it. I believe the return has been, so it's like 11. I think the return, yeah, the return is close to 20%. So it has been outperforming the market as a whole. And then when you look at the companies, the number one leading it is Netflix. Netflix has done really well. They've been clamping down on the people sharing passwords. They've been increasing their prices, and yet they aren't losing net subscribers. That they're still gaining more subscribers than they're losing. They added the additional revenue stream of having ads and commercials inside of it, where you have a lower price option, but you have the commercials. And then you have the higher price ones where you don't have to pay, where you don't have commercials. So Netflix is doing really well. And then Disney's been doing well. I think I even saw that they were up maybe like 5% today. So Disney has been performing well. And then obviously they own Hulu. And so you have that, Max. But it's so many streaming companies, right? It's just so many of them. It's like, what is everybody going to do? And then you have the cell phones. Cell phones are in here as well. The cell phone industry is an interesting one because for them, it's like their market is saturated. Everybody has a phone. So for the most part, and what you see on the commercials, you see it, they're basically trying to poach customers from someone else. It's like, hey, if you switch over, we'll bring your number and we'll give you this deal. Or you switch over, we'll give you a free phone or something like that. Because the assumption in their advertising is that everyone already has a phone. I'm just trying to get you to move your carrier over to me. And so you see that with the cell phone industry more than really any other industry. Most of the time when we're advertising, we assume that you actually don't have the product and I'm trying to get you to get it. Cell phones isn't like that. Cell phone, I accept the fact that everybody has a phone and I am just trying to convince you to have your phone with me. And because of that, you look at Verizon, AT&T, T-Mobile, even the internet streamers like Comcast and them, it ends up being where there's opportunities available, very stable companies that we're all familiar with, but it's just so competitive. It's so saturated that for you to continue growing as the way it is, where it's outpacing, it's very difficult to say. That is just something that has been doing pretty well. And I think Alphabet and Meta have been sort of leading the industry as a whole inside and with their AI, but their AI division is what I think is leading it, not as much their media and their advertising. And so that's why it's just a really tough industry where you have the upside because the company is a media company, but that portion of the revenue isn't inherently the thing that's driving their growth, but the opportunities are there. And so it is something that people have accepted, that they're going to pay like 7 or 8 media subscriptions, and then we're just going to have a whole bunch of different options available. So we'll be pretty good there. All right, so ultimately, let's finish this up. What does it mean for your retirement? I'm glad that you asked. For investment. All right, I think I have a question. Let me see here. All right, Kayla, useful information. I appreciate that. I'm glad you found it useful. Ronald, hey, bud, says, from an investing perspective, would you expect the market to be facilitated of hindered by current conditions? Look into your crystal ball. The market as a whole, yes, right. The market as a whole, yes, because the market likes to predict the future, right? Like that's its job. And while I do think long term the market always balances to the right price, short term you have opportunities that are available. The more unpredictable the time is, the more opportunities that are available because the market overcorrects or undercorrects or overreacts or underreacts. And that's why you're seeing what you're seeing, where the market will lose $6 trillion, this day, and then it'll gain $2 trillion the next day, but then they'll like go to sleep on it and they'll like, oh, I think I overreacted. And then the next day it loses another $1 trillion. So I do think from an investing perspective, I do think the market is going to be hindered by the uncertainty, because everyone's hindered by uncertainty, right? That's just the reality of it. If you're in the business of predicting things, right? If you run a business and you're trying to figure out how much seed you need to plant next year, you normally would look at certain indicators. Well, what if those indicators are changing every week? It'd be very hard for you to be comfortable deciding how much seed to plant. And that's how it is for all of these industries. It's like, I have a tariff today, so I'm going to make new logistical decisions. But then you find out you had a 90-day pause the next day, and you started making your changes. So then you'd be like, all right, I got bit once, I'm not going to get bit again. So I'm going to wait this out. I'm going to wait to see what happens in 90 days, which is what I think most companies are doing. They're like, well, I don't want to do something. And then, I don't know, something happens in 90 days and then I made the wrong decision. I'm screwed. My company goes out, files for bankruptcy. And so I think that as a result, a lot of these companies are going to not hire because they're not sure. They're not 100% sure if they need to build that warehouse, right? I said I'd build a warehouse. I'm not sure. So they're trying to wait it out. They don't know what to do with their inventory. Do I just bite the bullet and pay whatever the tariff is? Or do I wait to see if that tariff is going to be gone? And then I can just get my product. There's a lot of companies. And so I do think that ultimately does hurt the market as a whole, because you can't make any decisions. And that's what you're seeing. That's why the market is going up and down every day, because there are people who are trying to make the decision, the investors, while the businesses, people are being laid off, people are stopping hiring. Even if you were like, imagine if you were someone who was like a government employee, you took a severance package, and then someone went to the court, and the court said, no, you can't fire those people. And you're sitting there like, wait, oh, I have a job again. But then they go and they go to the appeals court, and then they're going to the Supreme Court. So now you don't even know. You as a person don't even know if you have the job. You thought you took a severance package. You thought you were fired. Now you find out you have your job. Now you're on hold again because the different courts are going different ways. It's really rough. It's definitely tough. It really is. Yeah. Good. I'm glad you found it useful. Yeah, I mean, and that's really what it is. And that's why ultimately the allocation is what's important. You just want to have an allocation that should perform well over the next 5 years. If you're retiring in 5 years, over the next 10 years, if that's your time horizon. If you have 20 years, you normally don't even look, right? Just keep your blinders on, because they're right. You're just like, all right, there's a lot of stuff going on, but I'm not going to worry about it. But if you're someone that's trying to retire in the next 5 years, I'm giving you my, the information. Obviously, it's informational. If we want to have a conversation, then I can help you with that. And so normally we diversify across the strong and stable sectors. And then you build the income streams that aren't market dependent. And the reason we normally end up doing that is because if the market does have a downturn, and that's why I normally advocate for the 3-bucket strategy. Because if you have income that you can pull outside of the market, when the market goes down, right, like the day that it went down like 6 trillion, or the days it went down 6 trillion, you don't have to sell your positions that day. And then it went back up like 2 trillion, right? But you still would have been there. And then it went down, and then it goes back up, but you're still there. So you're waiting, and you have a year inside of your cash allocation to allow that money to recover all the way. And then you have your income stream that could be outside of it. So it could be rental income, it could be a business income, it could be an annuity, it could be some bonds, it could be just something outside of the overall market, which then gives you the ability to allow the stock market itself to grow, to recover. And so that's why we always normally tell people it's a good idea to build the streams. And I'm a big fan of multiple streams. The numbers say that 65% of self-made millionaires have at least 3 streams of income. And so I'm a big fan of having multiple streams of income. And then they're from different sources, because as we always notice, in economics, there's a winner and a loser. As a result, you could win off of a recession if you have the right positions or the right assets. And so that's the way we think about it. And then number 3 is we would align our risk with our timeline. If we're 5 years or less out, we don't have as much risk that we could take on. If we're closer to the 10 and higher, we have the ability to take on a little bit more risk, because you do have to take risk. And the reason is because of inflation. If there was no inflation, sure, we keep the money in our savings account, put it on our mattress, never think about it. Life is fine, rainbows and Skittles. But because we have inflation, that ultimately means that we have to have our money growing to at least outpace inflation. And because you have to do that, you have to take on some risk. And I'm not saying take on all the risk, but whoever takes on the risk, that's how we get the returns. We get compensated according to our risk. That if you had an 800 credit score, what would you expect your auto loan interest rate to be? You expect the banks to give you 0 to like 2%, right? Like you'd be like, come on, dude, I'm 800. I have a spectacular credit. You know I'm going to pay you back. No risk. And they'd be like, fair. You're like, no risk. You're basically free money. I'm going to give you money. You're going to give me back. I have no doubt. But then what interest rate would you expect if you had like a 400 credit score? If you got approved, right? If you got approved. If you got approved with a 400 credit score, you would expect to have a 10, 15% interest rate. You'd expect it to be really high because the bank is taking on a lot of risk giving you that loan. You have a history of not paying people back. That's why someone has a 400 credit score. And so as a result, I expect my risk to be compensated with my return. And so as a result, you are taking some risk in the market, right? Don't let anyone tell you otherwise. There is a chance that you will lose money. But what we're also saying is that's the dance. Because you're taking on some risk, we're giving you the return. If you're not taking any risk, you're invested in US Treasury bills. That's the considered risk-free investments. The US Treasury bill right now, I think it's like 1% or something. Let me see. US Treasury bill rates. Let's see what they say. So you can get, oh, that's not bad. You actually get a 4%, right? So that's not bad. You can get a US Treasury bill right now for 4%. So that's not bad. Right. So that's where that is at right now. I guess if I was thinking about the interest rates being a little bit higher, I probably would have realized that's around what I would have expected. And so we would just go ahead and make those adjustments based off of that. We would do the absolute best that we can. All right, let me see if we have any questions or comments that I'll tell you about our philosophy. All right. So generally at Obsidian Wisdom, really what our overall goal is, we believe in wisdom, and the wisdom in the sense that you don't have to predict the future, but we just prepare for it. Or that's ultimately what wisdom is. We live long enough. We say that if I knew then what I knew now type of vibe, and it's not that we're fortune tellers when we live through the experience. We just start recognizing there were signs that I could have prepared for things, that I could have made adjustments, that I overlooked some things. Right? Like that's ultimately the reality. That's the idea of it. It's not that, oh man, I didn't know that would happen, which we sort of didn't, but we're not surprised when it did happen. You know what I mean? Like you're like, man, oh man, I wish. That's kind of the vibe with investing. It's not that we don't know what's going to happen, because obviously we don't literally know, but we know what's likely to happen in different cycles, because the cycle is the cycle. It's the same cycle with the seasons. I don't know in Florida how many hurricanes we're going to have, but I'm very confident that we're going to have a hurricane every year, at least one. And I know that the time of the year that the hurricane comes kind of around the same two times of the year. It's basically when it's really warm. So it comes a lot during the summer. It comes a little bit in the spring and a little bit in the fall, but mostly in the summer. We don't really have them in the winter because it's too cold. And then we normally know the way the seasons and cycles go. That's the same thing with investing. I may not know exactly when the recession is going to come, but I know that there's one every 10 years. I don't know exactly who's going to perform best in a recession, but if you tell me the situation, I can tell you who should perform the best in that environment. And that's really what you want to do when it comes to creating your overall investment strategy and approach. And again, if you want these slides, totally fine sending them to you. All you got to do, I mean, just message me or comment, and I will send them to you. It will be free. It's not a big deal or anything like that. I know that some of it is just kind of small to see, so that's why I want to be able to do that for you. And then we'll see if there is any additional questions. And if not, I'll let you go. All right. So Ron said, very useful info. I appreciate that, my friend. I appreciate it. Very useful info indeed. All right. If you have not, I'm always here for you, and I do appreciate the time together. If you enjoyed this, obviously let me know, give it a thumbs up, just let me know in the comments, and I'll make sure I do one of these, maybe once a month. We could just do a market look, and we can go through the sectors and see how they're performing. If there's anything that I can do to help you, feel free to reach out. You can just, if you're on LinkedIn, you can just send me the message like retirement planning, and then we can have a chat or anything like that. And then from there, I wish you luck in your overall retirement. And as always, I'm thankful for your time. Until next time, stay safe and enjoy life.